Hey everybody, welcome back to Dividend Stockpile. We're here today with David Nicholas, portfolio manager of XFUNDS and president and founder of Nicholas Wealth Management. And he's here to talk about their great income ETFs, FIAX, GIAX, and BLOX. So these funds are becoming very popular in the income investing space. So I want to have David on the channel to share more about these great funds. So David, welcome to the channel.
Jeremy, great to be here. Really excited. You have a great channel. So I'm just honored to be a part of it.
Oh, thank you. Appreciate that, David. Yeah, I love talking to portfolio managers and ETF providers about their funds. There's so many out there, and it's really hard for the general investing public to know all the details. And so by hearing directly from the person who's running the fund, it really goes a long way to understanding what the fund's about and hopefully generating interest in the fund itself. So really appreciate you coming on. Absolutely. So as an introduction, can you kind of tell us a little bit about yourself, your background, and how you kind of came to start XFUNDS?
Yeah, so a wealth manager, also portfolio manager of XFUNDS for our 3 ETFs. Yeah, I got started in the business. It's hard to believe, 20 years ago, 2005. So just crossed 20 years, which has really been an unbelievable 20 years. If you look at the run for the market over that time, we've had some pretty interesting things happen, right? You had 2008, you had the housing crash that caused the markets to drop 50%. You had 2015, China devaluing their currency, which added issues. You had obviously COVID, that was a mess. You had 2022, interest rate rising. So I've seen a lot in 20 years, and a lot of that is I've tried to take what I've learned through those periods and put that into what our investment philosophy is. And so, yeah, I've ran my private wealth business for many years, and started our XFUNDS just roughly 3 years ago now. And this is our 3rd ETF with BLOX. But like you mentioned, we have FIAX, GIAX, and then BLOX, which is our newest ETF as well. And so really, for us, it was, again, there's so many great options out there of income funds. And you've interviewed so many wonderful managers. And so for me, we didn't want to have I wanted to have a few things that are really good, right? Mm-hmm. And so for us, you're probably not going to see us come out with 100 or 50 different funds. But the funds that we do come out with, we're going to try to really drive value for our shareholders. So, really grateful and excited to talk with you today.
Yeah, awesome. So I know FIAX has been around for a few years. You said 3 years. GIX has been around for a little over a year. And BLOX is your brand new one, just a couple months. So I'm really excited to dig into all of these to kind of get a sense on what each one does, what it offers to investors, and let people decide what might be best for them in their portfolios. So back to your comment about everything going on in the market, I've been investing since 1999. So to your point, kind of seen all these different cycles that we've gone through. But I would say the last 5 years after COVID, we have definitely seen what I feel is like a lifetime of investment changes all in the last 5 years. We had huge dips, huge rallies. You pretty much got everything the last 5 years. So it's been quite the whirlwind for investors.
That's right. And I'll tell you, one of the biggest takeaways through all this is you really can get burned if you sit out of the market. And I always say that fear can drive investing decisions so much. And I even see it, right? Markets dip a little bit, investors get fearful. And I've just learned one of the worst things you could possibly do is try to time the market. And so as managers, we're taking all these inputs of different information to try to give us the best time to make a trade. But ultimately, markets head higher over time, and you want to be invested through these cycles. But if you can do it in a smart way, either by hedging or by generating income while markets are volatile, in the long term, I think you really can outperform.
Yeah, absolutely. That's what I was going to say about income. It really gives you this balance to your portfolio when the market's going crazy to have that income coming in every single month. And because the way you guys run your ETFs, volatility is actually beneficial for you. So you're harnessing that volatility to make that monthly or weekly income, where if you just held a long equity portfolio, you'd have to ride it up and down. You wouldn't have any income coming in. So I love this new suite of income producing ETFs that are out there on the market. I think the last 5 years or so have been so innovative with what's available to individual investors out there, XFUNDS included. So with that, so you said you're wealth management, you have a financial advisor. What made you want to open up these ETFs in the first place?
Yeah, so I had the private wealth business, and really it was post COVID. If we followed interest rates, right, we have been in a low interest rate environment for quite a while, right? Even from early 2000s until now, relatively low compared to where we were in the 70s and 80s. But interest rates hit rock bottom during COVID, And then all of a sudden, rates went from almost zero, and then we started to see inflation creep its head, and interest rates shot up, and treasuries became very popular. And for us, we have a lot of retiree clients, so clients that have built their wealth, now they're retiring, and they want us to manage their money for them. But we were getting phone call after phone call. David, I want to buy treasuries. David, can you buy me treasuries? I don't know how to buy treasuries. David, can we buy treasuries? And so we started to buy treasuries for our clients. And again, we try to drive as much value that we can. We were buying treasuries for our clients that were yielding around 5% at the time, 4.5% to 5%. But then we were charging our management fee. So if I charge a management fee of 1% on my clients, now their 5 really is 4, and now their 4.5 is really 3.5. And I in some of this just felt bad. I was like, I want to help our clients, but obviously we have to charge a little bit of a fee. And so I said, you know what? And I've thought of this idea for a while. I've shared with it on some other channels. But if you follow what insurance companies do, so if you go and invest, if you look at an average insurance company's balance sheet, whether it's Nationwide or Lincoln or Prudential, about 90 to 98% of their balance sheet is all fixed income. And so insurance companies have reserve requirements and fixed income, but then they take this little sleeve and they generally are going to buy long options, private equity. They'll buy sometimes equities with that. And they'll try to get a premium from that small position, leverage that small position over and above their bond income.
Yeah.
So I said, you know what, why don't we do a similar thing with FIAX? So FIAX was my attempt to try to recreate almost what a fixed annuity is, or an index annuity, where you get a very solid foundation, right? So 98% of the portfolio is U.S. Treasuries, short-term U.S. Treasuries and FIX. And then we do a little bit of an options overlay to try to generate a premium over Treasuries. The tariff sell-off for us this year was not ideal. Yeah. We were FIX was beating AGG, beating TLT. We were all fired up for 2025, and then April hit. Yep. And so again, this is why you learn. I always say the sell-off that's going to happen in the future is probably a unique sell-off, which is why the market sells off. Yeah. So a lot of our options were shorter term in FIX, means that they were expiring at the end of April. And so we started to lag a little bit in April, just full disclosure. But what we've really done since April, we've made some changes in FIX. One, we've brought our options positions out a lot longer. So we're now doing 3-6-month positions. So what does that mean? It will give the market time to recover. So even if the market sells off, we're not sitting on these options that are expiring, at the bottom of the market. Yeah. And so if you look at the performance of FIX since May, we've seen very steady NAV. I think the NAV is actually higher than where it was to start May, while we're giving out an 8% distribution. So I can go into these. We have some very, I would say, sophisticated option strategies on an FIX that you probably are not going to find anywhere else. But it's a very conservative. If you're a fixed income investor, conservative investor, you want hopefully a stable NAV with a higher yield that you'll get on Treasuries. FIX is a great fund to consider.
Yeah, that's a good balance between getting the stability and the safety of treasuries, plus that extra little bump in income from the options. And the nice thing about the longer dated options is if the market does go up, you can always get out of those options early and start over. So it's not like you're locked into it for the whole 3 months, but you're able to have that downside protection where you can give the market time to come back before the options really do start and affect the fund. So I think that's an overall great strategy.
That's exactly right. I'll give you a quick example. So if you look at FIX right now, we have an HYG trade on, which is the high yield bond ETF trade. So it's interesting what we did. We put on a high yield put vertical. So we sold a HYG spread. We got income for selling that spread. But what we did is we took all of that income and we bought long calls on the S&P 500 that expire. What does it expire? Yeah, December 19th of this year. Yeah. And so what are we essentially doing? We're almost in a way getting long S&P exposure, but we're paying for all of that long S&P exposure with the income that we generated off of our HYG spread. Yeah. So even if the market goes down, well, guess what? We only risk the interest that we got on our spread. So we're not getting any extra exposure, and that's a longer dated year-end trade. So the market can do, even if it sells off in September, hopefully by December, and our break even on that is our S&P long is 65.54, so a little bit above where the S&P is now. But anything above that, we're making profit on that trade.
Yeah, and I've heard a lot of analysts lately come out with year-end S&P targets in the 7,000. So if that works out, that's going to be a great trade for you guys. So, but to your point, you still have the stability of the underlying assets. You're just looking for that extra little bump, if you will. And that's going to benefit your shareholders over time.
That's right.
Awesome. Okay, so let's dig into a little bit of the other one. So we talked a little bit about FIAX. Let's talk about GIAX, which is your global equity exposure one. So can you talk a little bit about them? I guess the official name is Nicholas Global Equity and Income ETF.
Yeah,
so can you kind of give us an overview of what that one's about and what's the objective?
Yeah. So when we were looking to launch a fund, again, this is going back to I'm trying to launch funds that don't already exist in the marketplace, if possible. And so when we had a lot of S&P income funds, we had a lot of NASDAQ income funds that were available. We had a lot of IWM or Russell 2000 income funds. You had funds like JEPI and JPQ, but there really wasn't a global basket of equities or stocks that was also doing covered call income over it. And so I said, let's create that. And so if you look at the perspectives of GIX, really allows us to be global in our search for what we think are the best asset classes to add to the fund. I want to point out global doesn't necessarily mean international. Sometimes people confuse that with international. Global just means that, yeah, we can go domestic, we can go international, we can go small cap, we can go crypto. It unleashes, we have a global basket of equities and asset classes and sectors that we can choose from. So we're not going to be ever locked into just large cap US or, large cap tech. So it's really great in that sense. And so you're getting almost a type of hedge fund level management where we can go globally and then we're generating income. So if you look at the way the fund's broken down, happy to go through it as much as you want me to, but we've got a mix of ETFs. So we use Vanguard generally for our market exposure. Why? Because it's low cost and I like Vanguard and they do a great job. So we've got, about a 10% weighting to VOO, which is our S&P 500 ETF. We've got a roughly 9% weighting to VIG, which is our Vanguard Dividend Appreciation. We just added small caps about a month ago. That's been a great trade so far with the hope that the Fed lowers interest rates. We've got a 5% weighting to small caps, which will probably increase. And then we have individual names in the portfolio like Palantir, NVIDIA. We have 80YEY, which is a payments processor out of Netherlands. Great company, great management, great revenue growth, great earnings. Recently had earnings, but we still think it's a good name to hold. So you're getting a good mix between the index ETFs and also the individual positions as well. And so happy to go into the options overlay, but that's how the equity piece looks like.
Yeah, and it's nice to have an active manager that can make those decisions. You're not just stuck with, just S&P 500 or just the NASDAQ. And you have the ability to go where the market is leading. I see that you guys have some emerging markets in there, the Freedom 100 fund, which is I really like that fund a lot. I also see you have some Israel ones and Argentina ones. So you can really go out there and find where there's value in the market or where there's growth in the market to really enhance this particular fund. So it looks like you do all these global equities, like you mentioned, then you do an options overlay and you guys pay out monthly. Can you give an estimate of what the distribution is on GIAX?
Yeah, that's exactly right. So we actually do the options overlay. I would say I haven't actually seen any other income fund do it this way. So it's actually a pretty unique way that we do it. But the current distribution yield on GIAX is 24%. And so, if you look at the positions on our options overlay, we actually have our options overlay diversified into 3 different positions. We have currently S&P, NASDAQ, the NDX, and the Russell, RUT. And so what we do is we do a third, a third, a third in all 3 of those. And generally what we're going to do on this, these are our call spreads. So almost nothing of ours will ever have just a covered call. Because we want uncapped upside. And I think where a lot of these covered call funds really get hurt is if there's obviously a run up in the underlying and you get capped out, all it takes is one big miss on a run up and you can underperform pretty significantly. So we do a spread, which again, I'm sure many of us already know this, but we're going to sell a call and then we're going to buy a call right above it. The difference in the 2 strikes is what we call the spread. That's our premium for the trade. We build those trades to get about 0.5% per week. And so essentially we may sell it at the money or we may go out of the money depending on what volatility is. The higher volatility, the further out of the money that we can go. And this is what you said earlier. You're right. Volatility is actually our friend if you're an option seller. And so you can watch when those spreads get tighter or closer to the money, it just means there's less vol on the underlying. So we have to be tighter on the spreads. But this is very unique. And so by doing the spread and selling it at the money, if the underlying goes up, right, S&P 500, where we miss out on is the difference in that spread. But this is what's so unique. Most other covered call funds sell their options positions on the underlying, So our underlying is actually different exposure than what our spreads are. So what our hope is that even if the spread underlying is underperforming, our actual equity positions may outperform the offset in the spread difference. I don't want to get too technical, but that's really what we've been able to see, is that if our underlying positions have a higher beta than the spreads, we can actually make up for that difference in the spread, hopefully over time. And so really unique, diversified indexes. It's a monthly distribution, 24% yield, but you're getting really if you're someone that's saying, hey, David, I want income, but I don't want a lot of risk and I want broad diversification, GIX is really going to hit that, right? Broad diversification without focus on one sector or name in the underlying.
Yeah, you made so many good points there. Some of these other ETFs that focus on just a single index, and then they do right at the money calls, like the market goes up 75% of the time. And so if you're capping your upside at the money, you're never going to, your NAV's going to erode over time. You're going to miss out on all that upside. But by keeping a basket of equities that can grow over time, and then a separate bucket for your option strategy, gives you the best of both worlds. And 24% a year, I mean, most people would be very excited and very happy with that type of return. I heard you mention that you do it on the indices. Are you guys able to take advantage of the 1256 contract rule on those?
We are. Yep. So those are they get the 1256 tax treatment for that. So Perfect. The long-term, short-term as well, which is great.
Yeah, that definitely helps with the tax bill, because when I do my own options, I'm getting charged, my regular tax rate at the end of the year. But by allowing you guys to do it on the indices, you get a more preferential tax treatment for most people. So of course, talk to your advisor, that type of thing. Don't go by just this, talk to your tax advisor. But generally speaking, it gives you a better total return after taxes when you have something like the 1256 contracts.
That's exactly right. And just so based on our last distribution for July, 96% of it was considered a return of capital. So again, very tax friendly. Yep. If this isn't a non-qualified or a non-IRA account, if this is a cash or an individual or joint account, it's a very tax-friendly distribution.
Yeah, definitely. And a lot of people are concerned about ROC because they hear all the negative parts of it. But what it is a tax treatment on the distributions from the options. So over time, the options, you can make money, lose money. By the end of the year, you can offset each other, and you have the tax loss harvesting, but then also the 1256 contracts give you, that 60-40 split, which will help your tax situation as well. So return on capital is not a bad thing when it comes to options income ETFs.
Yeah, that's right. Exactly right. Because I'd rather be paying cap gains at some point in the future versus ordinary income. Generally, cap gains rates are going to be lower than ordinary income. So you're still paying tax on it. It's just in the year that you're receiving the dividends, you're not having to pay tax. When we go to sell shares, we will more than likely owe capital gains. But again, for some of us, we may not owe any capital gains if our income is low enough. And some of us, it's still going to be cheaper than ordinary income.
Exactly, because you're at 15 or 20% long-term capital gains as opposed to your current income rate, which is sometimes 20 to 30%, depending on maybe even more if you're in high.
God forbid you're in California or a high tax state, then that just stacks on top of bringing it back.
Yeah. All right. So let's move on to your other ETF, BLOX. That's your brand new one. It's a very unique fund, and it's in an industry that is definitely growing. So the high level is Bitcoin and Ether, plus the crypto industry companies, plus a weekly distribution. So that's a pretty good combo. Can you give us a little bit more detail?
Yeah, so BLOX has been so exciting since the launch. So really, my idea around BLOX was obviously we all know that crypto has been an asset class that has just grown substantially over the last few years. But really, for me, it was when the SEC approved Bitcoin to be inside of an ETF. It really opened the door for us to do something that I thought could be very meaningful. And so, I again, this is going back to my fiduciary private wealth cap on, and we deal with most of our clients, they've already built their wealth, right? And so they say, David, I built my wealth. I'm going to give it to you to invest, and I want you to take care of it, right? Yes. And so for us, it was like, okay, I could either tell our clients to go invest, just go buy Bitcoin or go buy a Bitcoin ETF. But for me, it's how do I value the price of Bitcoin? Well, I'm bullish on Bitcoin. I think it's going to do very well, but the price of Bitcoin is only what someone is willing to pay for it. Definitely. You can say, well, David, that's every asset, but at least with stocks, with a company that has revenue and earnings, I can reasonably give a multiple on revenue and earnings and give you what's a fair price for that. Yep. So I said, why don't we marry the two together? Meaning, why don't we take the Bitcoin, which I think is going to be a credible asset class over the next decade and beyond. Also Ether, which is about 10% of the portfolio. And let's marry that with actual equities that have real earnings, that have real revenue growth, that have real management, that are driving to hopefully drive returns for shareholders. And I think if you combine those two together, you can really own the whole crypto space. And so when I ask, hey, are you invested in crypto? I get, yeah, well, David, I'm invested in one or two coins or Bitcoin. And I say, for me as a crypto investor, I want to own the space. And so really, if you look at BLOX, that was the reason behind it, of a one-stop. I get exposure to Bitcoin, get exposure to Ether, but really it's these companies. And I've made this point before that, as Bitcoin becomes more and more prevalent, the standard deviation of Bitcoin is going to come down. And so if you're in a Bitcoin only covered call ETF, the best thing that could happen is Bitcoin goes up in price and volatility comes down. Well, again, that's bad if I'm selling covered calls on Bitcoin because I get less yield. But if I can marry it, the publicly traded companies, the standard deviation of some of these crypto names is significantly higher than even Bitcoin and Ether. So we can generate a lot of income, 3 times the income that we can in some cases on the crypto equity piece compared to just Bitcoin or Ether.
Yeah, so looking at your top holdings, at least the most recent one is the VanEck Bitcoin ETF, the Fidelity Bitcoin ETF are your 2 main Bitcoin exposures. But then to your point, you have the crypto-related companies. So you have Coinbase, you have Riot, I think you have Mar in there, you have Galaxy Digital. So all the companies that are in the Bitcoin and cryptocurrency space, those are real companies with real assets, with real revenues, especially Coin. Coin is blowing up. They want to be like the resource for anything crypto related. So there's definitely a lot of growth in that industry. And so in addition to just owning the coins themselves, you have exposure to the companies that are in that industry. So I think it's a really good mix. Now, I know it's only been around for about 3 months now or so, 2.5 months. What kind of yields are we expecting on this, and how often do you guys pay out?
Yeah, so this is something we went back and forth on because our 2 prior ETFs are monthly distributions. But with BLOX, we actually went to a weekly distribution. So our distribution date is on Monday. There was very few funds. I think there's only 1 or 2 that actually had distributions on Monday that I could see. So we have distributions on Monday. Every Monday we get our distribution, and we're currently paying out a 36 distribution yield.
Awesome.
We set that at 36%, so 3% a month. We can raise that. We can increase it in the future. But again, you may say, well, David, 36 doesn't seem like a lot. And you're right. We're generating a lot more than 36% yield on our equity positions. Bitcoin is right. You really stretch it if you want to get above 36 to 40% on Bitcoin, just given where the volatility is. But on some of our equity positions, we target 50% yield. And so with that is what determines how close to the money, again, just like we were talking about FIAX, how close, or GIAX, how close to the money that we go on our spreads. But really, we target 50, we distribute 36. We're not going to be profitable on every trade. I wish we were, but the ones that we are profitable, we will dollar cost average back in. So we, on Monday, we dollar cost average back into a lot of shares that were down, some of the names that were down. But it's just really unique because you've got the put spreads on the equity side that gives you uncapped all of the upside for the underlying and all of the income. We're currently doing call spreads on the crypto side. So you really get the best of both worlds between the call spreads and the put spreads on the equity side.
Yeah, and I mean, it's great. So if you have extra income coming in, you can just add it back to the balances of all the different holdings, which increases the NAV over time. So it's a good balance. Yeah, I mean, to your point, I do calls and puts on some of these names as well, and you can get sometimes even up to 100% a year on some of these names, but you're going to be taking a lot of risk, or you're going to do a large portion of the position underwritten or overwritten. Sorry, and so by capping it to that 50%, you still provide some upside on the underlying stocks themselves. So I think it's a really good package. All right, so we talked about 3 great ETFs: FIAX, GIAX, and BLOX. So where can people get more information about XFUNDS and these new ETFs you guys have?
Yeah, so our fund page is just nicholasx.com, but we also made it easy where you can go directly to the ETF page. If you just type in the ticker symbol and then ETF.com, so BLOX is just BLOXETF.com. You can go to GIAXETF.com or FIAX But if you can't remember that, you can just go to nicholasx.com. You can also follow me on X. I talk a lot about the funds with our different friends on X, and then also our fund page, just XFUNDS _ on X as well. And so lots of great information on there. There's also a pitch book. Most people don't realize. If you scroll down to the bottom, it's kind of hidden. We probably need to make it more legible, but you can click on pitch book. Really great resource. So if you just want to see a really nice PDF about the funds, you can click on that to learn more as well.
Yeah, in preparation for this meeting, I went through some of your pitch books. So yeah, it definitely is a great resource, and it really gives you a good understanding of the objective and the strategies and everything else that you guys use. So David, really appreciate you coming on, talking about your great three great funds here. Everyone definitely go check it out. I'll put all the links up on the screen. And David, thanks for your time, and we'll talk soon, hopefully.
Yeah, great, Jeremy. Thanks for having me. Honored to be here, and look forward to hopefully coming back again.
Yeah, I appreciate it. Okay, have a good day. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.